Hi, this is Nilus Mattive from Money and Markets TV. During my recent appearance at the Orlando MoneyShow, I got a lot of questions from viewers about topics I've discussed in the past. Today, I want to answer some of those questions. Several people were curious about the new covered call strategy I've started using in my dad's income portfolio, which has been wildly positive. They asked me, how are you deciding which specific options to write? And how hard is it to do this myself? Well, first of all, I only recommend writing contracts on stocks that we already own, so our choices are limited to begin with. Yes, some people do write calls without owning the underlying stocks, but that's a very dangerous approach. Still others buy stocks with the intent to write calls on them, but that's a strategy for very advanced traders. It entails too much risk for our purposes. Second, I only recommend writing out-of-the-money options contracts that would result in a solid profit should the calls get exercised. Once you've narrowed your choices down with those two criteria, start digging deeper to find options contracts that could fetch reasonable premiums. And base your expiration dates and specific strike prices on detailed analysis of the underlying stock's charts. The good thing about this strategy is that it's easy to get started. You just need to own at least 100 shares of an optionable stock. Then contact your brokerage to get level 1 options clearance, and in a few days you're ready to go. Another common question that could determine your investment strategy going forward is, where do you see the stock market going from here and why? Well, for the past couple years, I was in the minority, telling investors to buy high-quality, dividend-paying stocks while others were screaming sell. But now that so many more people are hopping on the stock bandwagon, I'm tilting back the other way. We've just seen one of the best yearly starts in the market in decades. But many of the fundamental issues plaguing the US and Europe have just been papered over by easy money. They haven't been solved. Plus, we have a tumultuous election season coming up. So I think it's likely that the stock bulls will take pause, or at least take gains, and we won't see too much more upside this year. Mind you, I still have a lot of dividend-paying stocks in my model portfolios, but I'm hedging those bets with covered call writing and other strategies. Turning from stocks to bonds, someone at my workshop last weekend asked, are you concerned about the safety of holding I-bonds now that paper certificates are no longer available? As of January 1st, I-bonds are only available in electronic format. But I think that having an electronic record of my bond holdings is actually safer than physical bonds, which could get lost or destroyed. Of course, this change does mean that you can only buy $5,000 worth of I-bonds a year per Social Security number, rather than the previous quota of $5,000 in paper bonds and another $5,000 electronically. But the fact that I've been recommending any type of government debt at all had people wondering, where do you stand on other types of Treasury bonds right now? In short, I would only consider those at the shortest end of the maturity scale. While we're likely to see a few more years of rock-bottom interest rates, I still don't like the risk-reward of longer-term Treasuries. I can't say when they might implode, or even if they will at all. But I know that I can find better yields in other places without the worries about Washington's finances. I'm Nilus Mattive for Money and Markets TV. Thanks for watching.